Hi there, this is Igor Pechkovskyi with Windermere Bellevue Commons, your trusted real estate advisor in the Eastside and Seattle. And in today's video, we will talk about something that you already heard about, is interest rates. Interest rates are going up this year, 2022. And the question is, how will it impact the market? What will happen? What is going on? And if you tune back to the previous video I make about the predictions for 2022, increased interest rates is one of them. And today, in today's video, we'll dive deeper into some analysis, some reports I have for you about why we need to increase our interest rates. And historically, looking back 30, 40 years ago, when we already been through this before, how did it affect the market? So get some popcorn, enjoy yourself. Let's go. 3, 2, 1, let's go. Boom. All right, let's start with some disclosure. First of all, I try to have as much fun with those things as possible. I'm not a chief economist, but I do have some very good data and reports for you. I am an educated man. I finished high school. And at the same time, there is a lot of these where I just express my opinion about things. So let's just start with why interest rates have to go up. To start with, I have to confess, I quite enjoy seeing crypto and stock market taking dumps, right? First of all, I think the latest number for cryptocurrency was like losing $110 billion in 24 hours. And the stock market lost some value too. I'm not an investor in both. I'm pretty sure you are. But both of these do not really represent our actual state of our local economies by any means, right? Majority of Americans do not invest neither in crypto or stock market. So the reason we have to increase interest rates is we have to take a grip of this raising inflation. Our inflation is at 7%. Last previous video, there were a bunch of articles about inflation and why, they also gonna printed so many new money for infrastructure and some new $1 trillion bills, and the deficit is ballooned, all of that. We got a ton of inflation. So the Fed has to do something, and they're going to increase interest rates. So when I say I enjoy those things, it's just the stock market reaction is like, no, you can't increase interest rates, stocks will fall. But hey, the price of meat, the price of gas, the prices for everything around here had been, ballooned, right? Because of the short supply of so many things. And the interest rates is the only tool in the Federal Reserve toolbox. When COVID started, boom, let's dump interest rate to 0, which we'll talk about. And when things are as hot as right now, they have to increase it. So those are the reasons why they have to increase to get a grip of an inflation. I've got a report for you provided by a very close friend of mine, Jim Murphy with Caliber Home Loans. And let's just talk about, what it was in the past and what can we expect in months to come. So let's dive into it. Let's start with 2021 recap. Interest rates. Expected rates to rise beginning of the year. Rates didn't rise sharply as they were promised, which they actually should have. Our market did 100 grand of appreciation on the east side just in December. They should have increased the interest rates last year. So the forecast, strong demand and tight supply would push homes prices up by high single-digit percentage. It was double digits. So there was strong demand, tight supply, COVID caused supply chain disruptions, labor shortages, push real estate values even higher than our robust forecast. 2022. So the Fed actually will be a major player this year. This year will be busy, but I think through the year, it's not going to be quite 2021 busy. Those interest rates will affect the market. So 2022 composition will be less accommodative than 2021. They should tighten over 2021. Fighting inflation is main focus, as I said. Negative stock market reaction could cause Fed to lose, resolve 40-year high in inflation. Fed should have hiked sooner, as I said, and history can help us forecast how the Fed actions 2022 will influence the market. Let's look at some history lesson. So Arthur Burns was the Fed's chief in 1970s. Didn't really pay too much attention to inflation, as you could see. Year over year inflation ballooned from 7% to 14% by the time he left office, 1980. Can you believe 14% inflation? We're at 7%, it seems insane. 14%, double of that. So Burns remained steadfast that inflation was transit. Have you heard that word recently, that inflation is, transitionary inflation? Well, yeah. So higher inflation caused mortgage rates to rise from 12% to 18%. Let's stop right there. So next time you complain that you got 3.2% and it used to be just 3%, 2 months ago, think about 18% interest rates. Are you kidding me? 18% interest rates. It's insane, guys. Even if you get 4% interest rates today, who cares? I know that we're emotionally attached to these numbers. A lot of buyers do. It's important to get the best interest rates. I'm with you. But every time I put it on perspective, even if you get it a little higher, 18% in 1980. Wow. So let's keep going. 1980, we got a new Fed chief, Paul Volcker. His mission was, let's fight inflation, right? So federal fund rates increased from 11 to 20% in 2 years. Today's Fed funds rate is basically zero. So that is not an interest rate fund. That's the rate at what the Federal Reserve lends money to banks, right? Today it's at zero. So banks get money at zero and get it to you at 3%, making great profits, right? But back then it was 11 and they increased it to 20%. So completely different story. Inflation dropped from 14% to below 5. And I'm gonna summarize this thing in the end. Because inflation dropped, mortgage rates sharply declined from 18% towards 12. So the moral of the story here is that they increase interest rates, right, to fight inflation. When inflation drops, they drop interest rates again. The stock market tanked, right? So the S&P 500 sharply declined by 30%. We kind of see it going on right now. Tighter monetary policy puts US into recession in 1982. So next, late 1990s, we kind of see a similar story again. Alan Greenspan, inflation doubled again from 1.7% to 3.5%. Mortgage rates rise from 7% to 8.5%, right? A lot lower already. And Greenspan took action immediately in mid-1999, and federal rate raised from by 1.75%. So inflation responded and dropped from 3.5% towards 1%. Same story 10 years later, where we see they do the same thing. Increase interest rates, inflation drop interest rates, okay? S&P 500 fell by 50% from spring to fall of 2000. No surprise there. US entered a recession in 2001. So let's bring it to a conclusion. Conclusion number one, stocks are highly overvalued. There was so much money dumped into stock market and so much money created and printed that I'm pretty sure that stock market is due for a correction. What do I know? You're watching it. Stocks are going to take a dump, right? And they should. So pay attention to stock market. You always say you want to buy at the bottom. There will be your chance to buy at a lower price if you're looking to buy in 2022. That'd be a great year for that. Conclusion number two, real estate market usually doesn't necessarily move. First of all, it takes a lot faster to liquidate stocks than liquidate real estate. Stocks, 2-3 days. To liquidate real estate takes 30 to 45 days. So the real estate market most likely, I do believe, will stay strong. In 2020, when stocks, fell, the real estate market didn't move at all and then skyrocketed right back up. So there'll be a reduced demand, hopefully for real estate. Increased interest rates should cool off the demand, and that'd be a good thing. And you should remember this, mark my words. You can change your interest rate. You could always refinance in the future date. Interest rates will go up, you still should buy, then they will go down, most likely, as we've seen through the history, you will be able to refinance. You cannot change your purchase price, you can change your interest rate. So lock your price. If you find some good piece of real estate, probably not gonna go any cheaper because of the tight supply we have, buy it. Even if your interest rate is higher, just go ahead and buy it and you'll be able to refinance. Do not spend money on buying off points or reducing your interest rate. It doesn't matter. Just get it with the higher interest rate you will, and then you'll refinance. All right. Well, and as you can see, housing forecast, conclusion number 2, exactly what I said. So 2022 will stay strong, might not be as strong as 2021. We will see some turmoil in the markets. We will see some volatility with increased interest rates, and that's your opportunity, I'd say. Don't be scared. You want to act when others do not act. Supply will increase, but remain tight. We need more supply, right? Tight labor, supply chain disruptions, and semiconductor shortages will all play a role. Rents will continue to rise. I'm gonna go with the rental analysis next. You'll be amazed, but rents probably will continue to rise, which will push more people to buy. That's why I say that the market will stay strong. So mid to high single digit appreciation, still providing great wealth creation opportunity. Folks, I know it's a lot to take. Call us, let's talk about it, put your comment. I'm curious to know what your thoughts are about this market. I'm excited about 2022. This was your real estate report with Igor Pechkovskyi, your trusted real estate advisor in Bellevue and Seattle areas. Thanks so much for tuning in, and let's look into, the rental market as well.